Hi, my name is Anna Hess, your Patton University course instructor. This is Unit 6. We're going to start with the introduction. In order to make the financial system as fair as possible so everyone has a chance to thrive, there are many rules put in place and enforced by a variety of independent bodies. These are the regulators. Regulation is an important aspect of the financial system and includes policies on sharing information, how much reserves banks must keep, and more. Regulations are usually first proposed and passed through the federal government. Beyond regulation, the federal government can have a large impact on the economy. The government affects the financial system and the economy through its taxing and spending activities or fiscal policies. The government can also set in motion changes in the financial system and the economy through its debt management policy. This policy strategy involves changing the composition of the government's debt, for example, changing the ratio of short-term to long-term government securities outstanding. Though the federal government's size causes it to have such a large influence, smaller states and local governments can also have an impact on the economy through similar means. For Objective 1, we're starting by reading Chapter 14, Regulating the Financial System. The painful effects of the global crisis of 2007 to 2009 brought home the importance of the financial system in our lives. Millions of people lost their job, their homes, and their wealth. Healthy firms needed to borrow temporarily to pay their employees, or suppliers faced ruins. As the crisis peaked in the fall of 2008, the global economy suffered its deepest and broadest downturn since the Great Depression, and policymakers took unprecedented action to keep the crisis from precipitating in a second Great Depression. In 2010, after financial conditions stabilized, the U.S. government enacted the most ambitious financial reform since the 1930s. The Dodd-Frank Wall Street Reform and Consumer Protection Act aims to prevent another crisis and to limit the moral hazard from the government's interventions during the global crisis. Although no financial crisis since the 1930s had matched the severity of the 2007 to 2009 episode, disruptions to the financial system are surprisingly frequent and widespread. After 2010, millions of people in the euro area faced devastating losses from the combination of a plunge of their sovereign's creditworthiness, the weakening of banks holding risky debt, and rising doubts about the viability of the euro. More broadly, since 1970, some 120 countries experienced nearly 150 banking crises. Including other types of financial disruptions, a crisis has occurred in an average of 8 countries each year since 1970. And virtually no part of the world has been spared from banking crises. Large, advanced economies have suffered along with smaller, less developed ones. Indeed, the banking disruptions appear to cause greater damage and persist longer in advanced economies, perhaps because the financial systems are deeper and more critical for sustaining economic efficiency. Partly as a result, governments in advanced economies are also likely to undertake a wider range of actions to support their banks, including liquidity support, guarantees of bank liabilities, and recapitalizations of weakened banks. When the financial crises occur, governments step in and put financial intermediaries back on track. They often do so by assuming responsibility for the bank system's liabilities, so that the depositors won't lose their savings. But the cleanup can also require the injection of capital into failed institutions. Not only are these crises expensive to clean up, but they also can have a dramatic impact on growth in the countries where they occur. Table 14.1 shows information on the economic impact and fiscal costs of selecting banking crises between 1970 and 2011. The data show what one would expect. Bigger crises are worse for output, and crises in advanced economies lead to larger increase in public debt as a percent of GDP. Some degree of default is normal at every bank, including well-run ones. But in 1998, when 35% of all loans made by Korean banks defaulted, it was more than just bad luck. Clearly, the Korean financial system was failing to perform one of its primary functions, the efficient channeling of resources from savers and borrowers so that credit goes to firms based on the merit of their proposed investments. Instead, borrowers who shouldn't have received loans got them, and projects that shouldn't have been funded went ahead. Because now resources were wasted, Korea's growth and income were lower than they could have been. To put the output loss shown in Table 14.1 into perspective, Korea has invested an average of nearly 35% of GDP annually since 1970. So the country lost 1 to 2 years' worth of banking investment. Banking crises are not a recent phenomenon. The history of commercial banking over the last 2 centuries is replete with periods of turmoil and failure. By their very nature, financial systems are fragile and vulnerable to crises. Unfortunately, when a country's financial system collapses, its economy goes with it. And with the economy crises, the risk of violence and revolution. Keeping banks open and operating, then, is as essential to maintaining our way of life as a ready military defense. Because a healthy financial system benefits everyone, the governments are deeply involved in the way banks and other intermediaries function. As a result, the financial sector is subject to voluminous rules and regulations, and financial institutions must withstand constant scrutiny by official examiners. The importance of this government oversight in ensuring financial stability is hard to exaggerate. When government oversight fails, as it did in many countries in the years before the crisis of 2007 to 2009, and in the run-up to the euro area crises that erupted in 2010, the cost can be enormous. The purpose of this chapter is fourfold. First, we will look at the sources and consequences of financial fragility. By and large, financial crises are banking crises, so we will focus on that sector. Included in this group are shadow banks that, like banks, have liabilities that can be withdrawn at face value virtually without notice, but are usually subject to less oversight than banks. Next, we will look at the institutional safeguards, for instance, deposit insurance. The government has built into the system in an attempt to avert financial crises. Third, we'll study the regulatory and supervisory environment of the banking industry. Finally, we'll examine emerging approaches to regulation that focus on the safety of the financial system rather than on individual institutions. The sources and consequences of runs, panics, and crises. In a market-based economy, the opportunity to succeed is also an opportunity to fail. New restaurants open and others go out of business. Only 1 in 10 restaurants survive as long as 3 years. In principle, banks should be no different from restaurants. New ones should open and unpopular ones close. But few of us would want to live in a world where banks fail at the same rate as restaurants. Banks serve some essential functions in our economy. They provide access to the payment system, and they screen and monitor borrowers to reduce information problems. If your favorite restaurant closes, suddenly you can still eat. But if your bank closes, you lose the ability to make purchases and pay your rent. So while no one suggests that the government appoint officials to minimize restaurant closings, everyone expects the government to safeguard banks. Banks' fragility arises from the fact that they provide liquidity to depositors. That is, they allow depositors to withdraw their balances on demand. If you want the entire amount in your checking account converted into cash, all you need to do is go into your bank and ask for it. The teller is obliged to give it to you. If a bank cannot meet this promise of withdrawal on demand because of insufficient liquid assets, it will fail. Banks not only guarantee their depositors immediate cash on demand, they promise to satisfy depositors' withdrawal requests on first-come, first-served basis. This commitment has some important implications. Suppose depositors begin to lose confidence in a bank's ability to meet their withdrawal requests. They had heard a rumor that one of the bank's largest loans has defaulted, so that the bank's assets may no longer cover its liabilities. True or not, reports that a bank has become insolvent can spread fear that it will run out of cash and close its doors. Mindful of the bank's first-come, first-served policy, frenzied depositors may run into the bank to convert their balances to cash before their other customers arrive. In effect, they hope that getting to the bank early will let them withdraw their investment deposit at a price above its true value, the value of the bank's assets. Such a bank run can cause a bank to fail. You're going to want to finish this reading on your own. After finishing the reading, you'll read an external page called The Watchman, then read an external page called Financial Regulations and Investor Confidence. Lastly, there's an activity of flashcards to review. This concludes Objective 1. For Objective 2, we're starting by reading Chapter 20, Money Growth, Money Demand, and a Modern Monetary Policy. Anyone who listens carefully to what central bankers say or reads what they write will form the clear impression that 21st century monetary policy has very little to do with money, despite its focus on inflation. That impression is reinforced by the technical papers that monetary economists write. Everyone talks about interest rates and exchange rates. No one talks about money. But digging deeper, you'll find that central bankers and monetary economists do care about money. After decades of studying the economy, the Nobel Prize-winning economist Milton Friedman wrote, "Inflation is always and everywhere a monetary phenomenon." Most economists would agree. We see concern for money too, in statements made by officials of the European Central Bank, ECB. In Chapter 16, we discuss the stability-oriented strategy that the ECB's Governing Council adopted this fall of 1998 to achieve the objective of price stability. The Council's strategy assigned money to a prominent role that was, in its members' words, signaled by the announcement of a quantitative reference value for the growth rate of a broad monetary aggregation. The idea was that deviations of money growth from reference value signaled a risk to European price stability. Since then, the ECB's monthly announcements of its target's interest rates have regularly mentioned money growth. Obviously, money plays a significant role in the formulation of European monetary policy. The contrast with the United States could not be more striking. In July 2000, after roughly a quarter century of publishing twice-yearly target ranges for the monetary aggregates, the Federal Open Market Community, FOMC, stopped doing so, explaining that these ranges no longer provide useful benchmarks for monetary policy. While the Federal Reserve still collects and publishes data on the monetary aggregates, FOMC members now mention them only in passing. They rarely make any reference to the money in public announcements of the federal funds target rate. In 2001, Federal Reserve Board Governor Lawrence H. Meyer went so far as to say that money plays virtually no role in the conduct of monetary policy. What accounts for the distinctly different treatment of money growth in the two largest central banks in the world? Why does ECB make regular public references to money growth while the Fed never does? If money growth is tied to inflation, why don't central bankers in the United States pay more attention to it? The goal of this chapter is twofold. First, it examines the link between money growth and inflation in order to clarify the role of money in monetary policy. Second, it explains the logic underlying central bankers' focus on interest rates. Why we care about monetary aggregates. We start with the single most important fact in monetary economics, the relationship between money growth and inflation rates. Panel A of Figure 20.1 shows the average annual inflation and money growth in 160 countries over 3 decades, from 1980 to 2009. This graph is striking for 2 reasons. First is its scale. Some countries suffered inflation that averaged more than 200% a year over 3 decades. Second, every country with high inflation had high money growth. History provides no examples of countries with high inflation and low money growth, or with low inflation and high money growth. One thing the figure does not show because of its scale is the huge number of points that fall very close to the origin, representing countries with both low inflation and low money growth. Panel B of Figure 20.1 displays the data for the 130 countries that experienced moderate money growth, averaging less than 30%. Over the 3 decades from 1980 to 2009, while the relationship between money growth and inflation is less striking, it is still clearly there. The higher rate of money growth is, the higher the inflation rate is likely to be. The 2 variables move together. This evidence alone tells us that to avoid sustained episodes of high inflation, a central bank must be concerned with money growth. Avoiding high inflation means avoiding persistent rapid money growth. Both panels of Figure 20.1 include a 45-degree line. Note that the points representing countries with very high inflation tend to lie above the line, while the points representing countries with moderate to low inflation tend to fall below it. As a simplified graph in Figure 20.2 shows, points lying above the 45-degree line represent countries where average inflation exceeds average money growth. Points lying below the 45-degree line represent countries where money growth exceeds inflation. To understand this relationship, think about what would happen if the inflation rate rose to 900% a year, as was the case in Nicaragua. See Panel A of Figure 20.1. That means prices would be rising about 4.5% a week. When the currency that people are holding loses value that rapidly, they will work to spend what they have as quickly as possible. As we will see shortly, spending money more quickly has the same effect on inflation as an increase in money growth. Connecting this relationship to central bank policy is straightforward. Recall from Chapter 17 that the central bank controls the size of its own balance sheet. Policymakers can purchase as many assets as they want. Issuing currency and commercial banks reserves liabilities to do so. Those liabilities, in turn, form the monetary base. Through the process of deposit expansion, the banking system turns the monetary base into monetary aggregates. Thus, the monetary aggregates cannot grow rapidly without at least the tacit consent of the central bank. By limiting the rate at which they purchase securities, policymakers can control the rate at which aggregates like M2 grow. In other words, it is impossible to have high sustained inflations without monetary accommodation. Not surprisingly, evidence of the link between inflation and money growth is the foundation on which modern monetary policy is built. That is why the ECB pays close attention to growth in the monetary aggregates. But to use the link as a policy guide, central bankers must understand how it works. Looking back at figure 20.1, we can see that all money growth is not created equal. Something beyond just differences in money growth accounts for the 3 differences in inflation across the countries. To see the point, look at panel B of figure 20.1 and note the vertical line at the point where annual money growth averages 10%. Points lying on or near the line represent countries that experience average annual inflation rates of between 1% and 8%. What is accounted for the differences in inflation among those countries? You're going to want to finish the rest of this reading on your own. After finishing the reading, you'll read an external page called Can the U.S. Economy Save the World? Then read an external page called Dodd-Frank, Too Big Not to Fail. Lastly, there's some flashcards to review. This concludes Objective 2. Okay, we're starting Objective 3 on page 365. The government safety net. There are 3 reasons for the government to get involved into the financial system. 1, to protect investors. 2, to protect bank customers from monopolistic exploitation. And 3, to safeguard the stability of the financial system. First, the government is obligated to protect small investors, many of whom are unable to judge the soundness of their financial institutions. While the competition is supposed to discipline all the institutions in the industry, in practice, only the force of law can ensure a bank's integrity. As small investors, we rely on the government to protect us from mismanagement and malfeasance. Second, the tendency for small firms to merge into large ones reduced competition, ultimately ending in monopolies. In general, monopolies exploit their customers, raising prices to earn unwarranted profits. Because monopolies are inefficient, and the government intervenes to prevent the firms in an industry from becoming too large, in the financial system, that means ensuring that even large banks face competition. Third, the combustible mix of liquidity risks and information asymmetries means that the financial system is inherently unstable. A financial firm can collapse much more quickly than an individual company. For a steel corporation, an electronics manufacturer, or an automobile maker, failure occurs slowly as customers disappear one by one. But a financial institution can create and destroy the values of its assets in an astonishingly short period, and a single firm's failure can bring down the entire system. Government officials employ a combination of strategies to protect investors and ensure the stability of the financial system. First, they provide the safety net to ensure small depositors. Authorities both operate as a lender of the last resort, making loans to banks that face sudden deposit outflows, and provide deposit insurance, guaranteeing that depositors receive the full value of their accounts should an institution fail. But this safety net causes bank managers to take on too much risk, leading to the regulation and supervision that we will discuss later in this chapter. This section will examine the unique role of depository institutions in our financial system. The point is that we need banks. While they are essential, they are also fragile. This leads to a discussion of the components of the safety net and the problems it creates. The next section will look at the government's responses to these problems. The unique role of banks and shadow banks. As the key providers of liquidity, banks ensure a sufficient supply of the means of payment for the economy to operate smoothly and efficiently. This critical role and the problems associated with it make banks a key focus of attention for government regulators. Shadow banks are also major providers of liquidity, and following their role in the financial crisis of 2007 to 2009, they also have attracted intense attention from regulators around the world. We all rely heavily on these intermediaries for access to the payment system. If banks, MMFs, and security brokers were to disappear, we would no longer be able to transfer funds, at least not until someone stepped forward to take their place. Other financial institutions, insurance companies, pension funds, and the like, do not have this essential day-to-day function of facilitating payments. Furthermore, because of their role in liquidity provision, banks and shadow banks are prone to runs. These intermediaries hold illiquid assets to back their liquid liabilities. In the case of banks, their promise of full and constant value to depositors is based on assets of uncertain value. The fixed value shares of MMFs are like bank deposits in all but name. The liabilities of other shadow banks are less similar but have important deposit-like characteristics. For example, repurchase agreements are usually overnight contracts, so a repo lender can refuse to roll over the loan to a security broker at virtually any time, an action similar to a deposit withdrawal. In contrast, pension funds and insurance companies, and even some hedge funds, may hold illiquid assets. Their liability holders cannot withdraw funds whenever they want. Moreover, banks and shadow banks are linked to one another, both in their balance sheets and their customers' minds. Take a quick look back at Table 12.1 on page 299, and you will see that in January 2016, interbank loans made up less than 0.5% of U.S. commercial banking system assets, which was less than 4% of all bank capital. Prior to the crisis, interbank lending had been substantially greater and represented throughout 1/3 of all bank capital. If a bank begins to fail, it will default on its loan payments to other banks and thereby transmit its financial distress to them. Similarly, MMFs hold large volumes of commercial paper, most of which was issued by banks. And the shadow banks are among the key repo lenders and security brokers and hedge funds. Banks and shadow banks are so interdependent that they are capable of initiating contagion through the financial system. Other financial institutions also may pose such risks, but these intermediaries typically are very large and few in number. See footnote 4 regarding the derivatives exposures of AIG, the largest U.S. insurer when the crisis of 2007 to 2009 hit. While the ramifications of a financial crisis outside the system of banks and shadow banks may be more limited, they are still damaging. As a result, the government also protects individuals who do business with finance companies, pension funds, and insurance companies. For example, the government regulations require insurance and companies to provide proper information to policyholders and restrict the ways that the companies manage their assets. The same is true for security firms and pension funds, whose assets must be structured to ensure that they will be able to meet their obligations many years into the future. The government as a lender of last resort. The best way to stop a bank failure from turning into a bank panic is to make sure solvent institutions can meet their depositors' withdrawal demands. In 1873, the British economist Walter Bagehot suggested the need for a lender of last resort to perform this function. Such an institution could make loans to prevent failure of solvent banks and could provide liquidity in sufficient quantity to prevent or end a financial panic. Specifically, Bagehot proposed that Britain's central bank should lend freely on good collateral at a high rate of interest. By lending freely, he meant providing liquidity on demand to any intermediary that asked for it. Good collateral would provide assurance of borrowing institution's solvency, and the high interest rate would penalize the borrower for failing to hold enough reserves or easily saleable assets to meet deposit outflows and would promote rapid repayment when funding conditions normalized. The existence of a lender of last resort significantly reduces, but does not eliminate, contagion. The series of 3 bank panics that occurred during the Great Depression of 1930s is one example of the failure of a lender of last resort. While the Federal Reserve had the capacity to operate as a lender of last resort in the 1930s, Figure 14.1 shows that banks did not take advantage of the opportunity to borrow when they needed to. In fact, their borrowing fell during panics, reaching levels well below normal compared to the boom years of 1920s. So as banks became illiquid, the Federal Reserve's lending declined. The mere existence of a lender at last resort, then, will not keep the financial system from collapsing. You're going to want to finish the rest of this reading on your own. After finishing the reading, you're going to want to read a reading called Budget Surplus Could Dwindle. Then read an external page called Does Government Spending Affect Economic Growth? Lastly, there's some flashcards to review. This concludes Objective 3. For Objective 4, we're starting with Chapter 10, Foreign Exchange. Every year, moving goods and service around the globe becomes easier. Currently, the volume of international transactions, summing export and imports of goods and services, amounts to more than 1/2 of world GDP. Today, Americans buy cell phones and clothing made in China, computers assembled in Singapore, and fruit grown in Chile. But global business deals aren't limited to goods and services. Individuals, companies, and governments also invest abroad, buying and selling stocks and bonds in financial markets around the globe. The magnitude of the international flow of goods, services, and assets is impossible to ignore. To understand the nature of these transactions, we must become familiar with a key tool that makes this trade possible: exchange rates. Whenever you buy something that has been made abroad, whether it is an article of clothing, a car, a stock, or bond, someone somewhere has exchanged dollars for the currency used where the item was made. The reason is simple. You want to use dollars to pay for an imported shirt that you buy in a local store, but the Malaysian producer wants to be paid in ringgit. All cross-border transactions are like this. The buyer and the seller both want to use their own currency. The exchange rate, at its most basic level, is the tool we use to measure the price of one currency in terms of another. Exchange rates have broad implications both for countries and for individuals. Take the case of South Korea in the winter of 1998. As economic and financial turmoil spread through Asia, starting in the summer of 1997, output and employment plunged. In Korea, large industrial companies and financial institutions approached bankruptcy. From October 1997 to January 1998, the number of South Korean won needed to purchase $1 more than doubled, rising from 900 to 1,900. See Figure 10.1. The consequences were dramatic, both inside and outside of the country. When the cost of buying the won plummeted, South Korean products became much cheaper for foreigners to buy. As the value of the won dropped, the U.S. prices of Hyundai cars and Samsung televisions fell with it. At the same time, U.S.-made products became extremely expensive for South Koreans to buy. In fact, the crisis became so severe that many Korean students in U.S. colleges and universities had to go home. The price of a U.S. education, measured in won, had doubled, and many Korean students just couldn't afford to continue. Exchange rates go through long swings as well as sudden spikes. In 1973, the currency used in the United Kingdom, the British pound, or pound sterling, was worth $22.50. Over the next 47 years, its value declined by more than 40%, so that by early 2016, 1 pound was worth $1.43. See Figure 10.2. Nevertheless, Americans visiting London during January 2016 did not return thinking that their vacations had been very inexpensive. At an exchange rate of $1.43, a hotel room in London cost about the same as in New York, and dining out was no bargain either. How are foreign exchange rates determined, and what accounts for their fluctuation over days, months, years, and decades? This chapter provides an introduction to foreign exchange rate and exchange markets. Foreign exchange basics. After graduation, you are planning to travel to Europe. You would like to see the Eiffel Tower in Paris, the Colosseum in Rome, and the Parthenon in Athens. As you pack, you worry a little about paying your hotel bills and the tab for all that great food you expect to eat. The waiters in French, Italian, and Greek restaurants aren't interested in your dollar bills. They want to be paid in their own currency. But you're fortunate, for while the French, Italians, and Greeks speak different languages, they all use the same coins and bills. In fact, buying anything in Europe, at least in the countries that are members of the European Monetary Union, means exchanging your dollars for euros. So when you get to Europe, you will care about the rate of exchange between the dollar and the euro. The price of €1 in dollars is called the dollar-euro exchange rate. Nominal exchange rate. Exchanging dollars for euros is like any other economic transaction. You are using your money to buy something. In this case, money to spend in another country. The price you pay for this currency is called the nominal exchange rate, or simply the exchange rate. Formally defined, the nominal exchange rate is the rate at which one can exchange the currency of one country for the currency of another country. The dollar-euro exchange rate is the number of dollars you can get for each euro. In January 2016, €1, the symbol for a euro is that, would buy roughly $1.10. So an American who went to Europe in January 2016 paid about $110 for 100 euros. Exchange rates change every day. Figure 10.3 shows the dollar-euro exchange rate since the inception of the euro in January 1999 to January 2016. The figure plots the number of dollars per euro, which is the conventional way to quote the dollar-euro exchange rate. When the euro was introduced, it was worth $1.17. But by October 2000, less than 2 years later, it could be exchanged for only 83 cents. Such a decline in the value of one currency relative to another is called depreciation of the currency that is falling in value. During the first 22 months of the euro's existence, it depreciated nearly 30% relative to the dollar. Later in this chapter, we will consider the reason for large movements in exchange rates. At the same time that the euro was falling in value, the dollar was rising. After all, if you can buy fewer dollars with €1, you can get more euros for $1. The rise in the value of one currency relative to another is called the appreciation of the currency that is rising in value. During 1999 and 2000, the euro's depreciation was matched by the dollar's appreciation. They are really one and the same. When one currency goes up in value relative to another, the other currency must go down. Note that, theoretically, exchange rates can be quoted in units or of either currency. For example, as the number of dollars needed to buy €1, or as the number of euros needed to buy $1. The two prices are equivalent. One is simply the reciprocal of the other. In practice, however, each currency has its convention. The price of the British pound is quoted the same way as the euro, so that people talk about the number of dollars that can be exchanged for £1. The price of the Japanese yen is quoted as the number of yen that can be purchased for $1. Unfortunately, there is no simple rule for determining which way a particular exchange rate should be quoted. Most rates tend to be quoted in the way that yields the number larger than 1. In fact, that €1 equals $1.17. When the euro was created in January 1st, 1999, it is likely explanation for why we talk about the number of dollars needed to purchase €1. Ever since, people have quoted dollars per euro. Even though there have been significant periods of time when the number was less than 1, if you need to guess which way to quote an exchange rate, the best guess is that it's simply the way that yields a number larger than 1. But the real solution is always to state the units explicitly to avoid confusion. You're going to want to finish the rest of this reading on your own. After finishing this reading, you'll want to read another reading called Foreign Exchange Settlement Shows the Lessons Banks Have Learned. Then there's an external page called Foreign Currency Manipulation Does Not Warrant Washington's Attention. And then there's flashcards to review. This concludes Objective 4, and this concludes Unit 6.